Hey guys, Justin with Deep Dive Stocks here, and today we're going to be going over one of the more simple but highly effective tools that you can utilize to protect your portfolio, and that is hedging. So let's go ahead and get started. So today is honestly going to be pretty short. I think hedging is has a lot of like mystification behind it, but we're going to see that it's pretty simple. And so we're going to talk about why, which is pretty straightforward, right? We're going to talk about how. Just going to go over two basic examples that probably cover 90% of the hedging that me or you would have to do. And then we're just going to go over two examples to really nail the point home, and then we'll be done. But like I said, this is a topic that I think intimidates a lot of people, but we're going to see that it's pretty straightforward and it can actually do wonders for your portfolio. So why? Well, that's pretty simple, right? We want to save money. We have a position in our portfolio that has either gained a lot of value that we want to secure, or we have a position that is losing too much value and we want to be able to neutralize that position against further loss. And like I said, as we're going to see, it's pretty straightforward. There's really no reason if you play in the market, having a good understanding and being comfortable with hedging is absolutely a skill set that you should cultivate. So how is really going to depend on the position, but we're going to see that there's really like the overall theme is the same. But with the two examples we're going to go through now, we're going to see that with the long shares and the call and the put spreads, like I said, these are going to cover about 90%, if not more, of what me or you would have to hedge in our portfolio. And even though if you were to expand this beyond to like other positions, the principles would remain the same that we're going to see here. So let's look at our friendly neighborhood trader, Sally. Sally has some long shares on a stock. She has 75 shares, but unfortunately this stock has just been nosediving recently. And she's starting to get concerned that her portfolio is just losing too much value. But she doesn't want to exit her position. She still has some long-term faith in the company. She wants to keep her shares, but she's concerned that over the next month, it may just lose too much value. It may depreciate too much, and it's kind of bumming her out, right? So what can she do? Well, since Sally has 75 shares, she can simply go into the market and find a put about 1 month out, since that's kind of like her window of concern, that has 0.75 delta. This put with its 0.75 delta will completely neutralize any further movement of her 75 shares, at least for the next month, until either the put expires or she exits the position. So effectively, she is now neutral to the underlying, and she can just wait out the next month, which is her self assessed time frame of risk here, right? But for the next month, she's pretty neutral to the underlying, so she doesn't have to worry too much anymore. And it's that simple, right? She just goes into the market, finds a put that has the equivalent number of delta that she has shares, just divide the number of shares by 100, purchase the put, and you're neutral. That's it. So now your portfolio won't be red every day. It'll just be flatlined, right? Which is better than red. So let's say that this time, however, she has a debit call spread. So she's purchased a call, she's also sold a call, and this gives her a nice P&L chart of this. So as the value of the stock rises, the value of her position will rise. But again, let's say that for some reason the position is falling, but she still has some long-term confidence that the call put spread will be profitable in the future. And she doesn't really want to close out the position, wait the time, pay more premium to open the position again. She kind of just wants to keep her position, but for whatever reason, but she does want to kind of neutralize this current downturn in price. So she simply purchases a put spread, right? Which we can see when she purchases the put debit spread, it mirrors or is inverted of the call spread. So as the call spread loses value, as the stock price drops, the put spread gains equal amount of value. And so she's neutral to the underlying, and she can close out that put spread whenever she needs to, or whenever she feels like it's time to resume the just being long on the stock. And it may seem like we're going pretty fast here, but this is essentially it, right? So this will cover 95% of the positions that the average trader like you or me will ever have. We own shares, we purchase calls, input spreads. Occasionally we might get fancy and do some theta gang stuff, calendar spreads, short iron condors, but the vast majority of the time we simply either are long or short a stock. And that doesn't mean that we can't utilize some extra tools to just make sure our positions are secured. So let's look at some examples with numbers. So let's say Sally again, she's short 50 shares of some stock, but this time the stock is rising in price a little too much. But again, she still thinks that this short position is worthwhile. She doesn't want to exit it. So she just needs that long delta to cover her short shares. And if this terminology is new, I would definitely recommend checking out my video on delta. And just kind of getting familiar working with the idea of long delta, short delta, what has what. But the long delta, in order to neutralize her short shares, she can either buy a call because they have long delta, or she can sell a put because that has long delta. But at the end of the day, she simply just needs she needs to purchase a call with 0.50 delta, or she needs to sell a put with 0.50 delta over whichever time frame that she thinks that she's at risk. So if, like in the previous example, she thinks the price going up may last another month, well, then she would probably want to purchase a 0.50 delta that has an expiry about 1 month out. If she thinks this is more short-lived, say like a week or two, then she would just purchase a call or sell a put with 0.50 delta with an expiry of 1 or 2 weeks out. And that's it. That's all she would have to do. So she is going to pay a little bit to open up this. She's either going to receive some premium if she sells the put, or she's going to have to pay a little bit to buy the call. But essentially, that's just insurance, right? She's purchasing insurance on her position so that it doesn't lose too much value. Another example is the debit spread. So suppose Sally is opening up a call debit spread on a stock that is $10. She has a modestly bullish outlook. So she sells a $15 call, she buys a $12 call, and this is a call debit spread, and this gives us the nice P&L that we saw before, where the current price is $10, the inflection point where she starts gaining value is going to be $10, and the maximum profit is going to be $15 or above, and this is going to be at expiry. It's going to be a little different before expiry, but it's a good approximation. But let's suppose the next day the stock rises, it experiences a huge run, and it goes all the way to $20. Well, now she's at the max profitability for her spread, but unfortunately, Sally is restricted by the day trading rules, which a lot of us are, right? So she doesn't have a nice healthy chunk of cash in her brokerage, so she can only trade a certain amount of day trades a week. And so she can't exit this position because it's two options. She purchased a call and sold a call. So if she closes that spread, if her brokerage has to split that position into its two legs, the long call, the short call, that could count as 2 day trades against her, which is a pretty risky thing to do, and especially if Sally already has some day trades against her. So what is she going to do? She's concerned that if the next, she might wake up tomorrow and the stock has dropped back down to $10. So, does she risk it? Does she... you could get some pretty hefty punishments if you violate those day trading rules. So Sally, instead, she chooses to buy a put spread. So just like we saw before, you just invert the call spread. So she would purchase a $15 put. She would sell a $12 put. And as we saw before, this now will neutralize her call debit spread with a put debit spread and immediately lock in her $20 profit. Or the profit she gained from the stock rising to $20. Now she is going to, there's going to be some costs associated with opening up this put spread. But again, the alternative is that she might wake up the next day, 9:30, the bell rings and the stock immediately drops to $10 before she can even close her position. But once she opens up the put debit spread, as soon as that position is opened, the profits are locked in. She will, she can wake up the next day. The stock could be $1, doesn't really matter. She'll just sell this call spread and this put spread together as one unit, or put in two sell to close, and the net result will be that she locked in her profit as if the stock was $20, and that could be pretty powerful, especially for those of us who have those day trading rules. And this also works if you just purchased a call, if you purchased a put. How are you going to lock in those profits if the stock does do one of those nice big moves that you were hoping for? Well, you can simply just purchase the opposing side of the trade. Now you hold basically the equal shares or equal position if the stock goes up, if the stock goes down, and you've just locked in your profit. So pretty cool, huh? Locked in the profits. So really the main takeaways here is the market is dynamic. It doesn't always behave how we would like it to, but that doesn't mean that we are without tools. We have a lot of tools in our toolkits. We just kind of have to practice them. You're going to do it a few times. It's going to seem strange, a little abnormal, especially if you have a position that's losing value and then you go and spend more money to hedge that position. At first, it kind of seems odd to spend money when you're already losing more money, but it can really make a big difference in your portfolio, and it can really be the difference between seeing like a consistent small losses, and then all of a sudden now you're seeing that nice consistent small gains. And that's really the name of the game here in the market, is just you want more green days than red days, and this is definitely one of the tools that can help you get there. And as we've seen, hedging is safe and effective. It's really not as exotic, it's not as wild, I think, as it's talked about. We always kind of talk about hedging with the market makers, the options dealers, the large institutional investors, and yeah, they do some pretty exotic, crazy hedging, but that doesn't mean that that's the only type of hedging or the only type of hedging that's effective. We see here that selling a put or selling a spread, buying a call can really be very impactful on your portfolio. And so that's hedging. That's Deep Dive Stocks, a little primer on hedging. I hope that this has been helpful. If you like, please like, comment, subscribe. Let me know how I'm doing. If you have any other suggestions on videos to do in the future, just let me know. I'm always looking for ideas. And I hope everything's well. And happy trading, guys. I'll see you guys next time. Bye.